Hi everyone. So on this video, I'm going to help you understand that if you have 1 crore rupee, how exactly you should build a portfolio. Now this is going to be a slightly advanced topic and I'm going to cover a lot of insights through my own experience of managing a lot of money. For people who don't know about my background, my name is Akshat Shrivastava. In the past, I've worked with top management consulting firms like BCG Dalberg, and now I run my hedge fund. I manage a lot of money. I have a lot of my personal wealth tied into the capital markets. On everyday basis, I manage money. So I glean a lot of insights, which I will share with you, some of it on this video. Now, this is a serious learning video. In case you don't have time, please do not watch it. It will harm you more than help you. So please only watch it if you have the time and if you can commit to watching it fully. So let's begin and I'll not waste any time. And here is the spreadsheet that I will show you. This is designed for 3 types of investors. One is a low risk, one is a mid risk, one is a high risk. Now, I'm going to talk about some contrarian points, which you might or might not agree with. It's completely okay. You are entitled to your views. Similarly, I am entitled to my views. So I'm going to share that with logic, right? Whatever I'm saying on this spreadsheet, and accordingly, you can pick and choose whatever works for you. So the first key thing that I will tell you is that when you're designing a portfolio, it has a goal. The goal primarily is that it should beat a certain benchmark. In most cases, we compare this to Nifty 50 in India, that if you have a portfolio and if you are investing primarily in large caps, then the benchmark becomes Nifty 50 or Sensex. Okay. And typically because Sensex grows at roughly 12 to 13%, so we assume that, hey, if your portfolio is performing 12-13%, it's doing a decent job, right? Now, of course, you might meet your friend. He will say that, you know what, boss, I'm generating like 20% CAGR. You'll get impressed. You'll ask him that, how are you generating it? Then he'll say that, yeah, I'm going to like small cap, mid cap stocks primarily. So that's his benchmark. So similarly, you need to decide your benchmark. That's literally goal 1 of portfolio building. And here, what I would suggest is that you take an inflation-based approach. Now, what is the meaning of inflation-based approach? So the meaning of inflation is the rate at which prices go up. Now, in India, it is typically said that prices go up somewhere around 5 to 6% a year. That's what the official or government-backed inflation data is. Now, see, here we have to understand the concept of segmental inflation. Now, segmental inflation in very simple language means that, see, the 5-6% is the average inflation in India. This is not the inflation that might be hitting you if you're living in Gurgaon or Mumbai or Delhi, all these different metros. Your kids are going to private schools, you are availing private healthcare facilities, you're traveling through Indigo flights or Air India flights or whichever flights you are being okay traveling these days. So the point being that inflation for you will work very differently. Now, that's the concept of segmental inflation. I was one of the early influencers to talk about it. I started talking about it 2 years ago. Now everyone is talking it. But long story short, whatever portfolio you're designing, it needs to service your lifestyle, and therefore taking an inflation-based approach makes sense. So the first key takeaway is that if you actually study the segmental inflation, I would put the number between 10 to 12%. If you are a middle class Indian, right, or a rich or upper middle class person, right, who has 1 crore to invest, your wealth is getting eroded at 10 to 12%. So you need to grow your wealth at least at between 10 to 12%. If you are growing it less than that, then you are not really growing wealth. And here is where the second definition comes. The second definition is the concept of investment. Okay, so investment, the dictionary meaning of investment is that something that grows in value with time. Now, for example, when you're putting your money in equities, right? So equities means stocks, then they will typically grow more than 10 to 12%. So we can put them an investable asset class that at least by, you know what, equities are growing like more than 10-12%. So it's an investment. But if you are picking bonds and you would say that I have assigned a number big fat 0 here, I have put 0 here, even for like low risk investors. Now, why have I done it? This is a very controversial thing to do because the fact that bonds in India do not give you inflation adjusted returns also. So it's not something that is growing in value. This is the logic. Take it or leave it. It doesn't matter. Now, many of you would say that, you know what, you are just misguiding investors or whatever it is. See guys, here we are talking about investors who can afford to build a 1 crore portfolio. These are rich guys. Okay. Investing comes after your emergency fund is built. Everyone should have an emergency fund. For example, if you're old, then you should have maybe like 3 years of emergency fund at least. If you are like in your 20s, then having 6 months of emergency fund is fine. If you are in mid 30s, 40s with family responsibility, then 2 years of emergency fund is okay, right? So this emergency fund is different. Okay, emergency fund is very, very different. Only when this is done, emergency fund means that, okay, you know, your mahine ka kharcha is like 1 lakh. So on a 3-year basis, so it becomes like what, 36 lakhs. This should be saved. Okay. So this is for old people. Okay. This is for average. This is for extremely young people. So this emergency fund you should anyways build, no doubt about that. Only then you should go into like, how to build like 1 crore portfolio types of debates. Okay. So this is one. And therefore I have assigned a big fat 0 to bonds. Why? Because in India, bonds are deeply inefficient. How exactly bonds are inefficient? Number one is that risk wise, it's not as if that Indian bonds are safe. For example, there was a company called as DHFL. They defaulted, bond holders, entire bonds went to zero. So it's not as if that bonds are risk free. Second key point, and more important, is that bonds are basically tax inefficient. Now in India, debt or bonds are taxed at slab. Now here we are talking about rich guys who have like 1 crore rupee. And if you are putting and throwing your money in debt or bonds, you are paying highest effective tax. It doesn't make sense. Now this might be different if you are an NRI in some other countries. For example, I am a UAE based NRI. Now for how much tax do I pay on my bonds? The answer is big fat 0. Okay, why? Because the bond taxation in UAE is 0. So therefore I pay 0 tax. How much returns do I make? Well, I make somewhere between 4.5 to 5% in USD terms, right? So this in INR terms will come out to be at least 8.5%. So this is my tax-free return on bonds. So for me, investing in bonds is sensible because I'm based in a jurisdiction where the tax efficiency on bonds is there. In your case, it might not be the case. So since this video is catered primarily towards Indian audiences, bond investing for people who have like 1 crore rupee, it does not make sense, right? That's what I'll simply tell you. That's a contrarian point. It's okay if you want to put a little bit of money here, there, it's completely fine. But in case you are thinking that, bond investing is really safe, it's great, it's preserving my wealth. No, a better option nowadays is gold. Okay. And this is like, again, slightly contrarian advice because I do not buy gold, but for certain types of people, gold investing kind of makes sense even more and more now. Why? Because number one, gold. Technically, you can save taxes on gold, right? If you're buying physical gold, hypothetically, for example, you don't really need to declare it to authorities per se. I'm not telling you how to evade taxes. I'm just telling you the reality of finance, that if you're buying bullion in physical format, you might not declare it. And that is where I'll leave this conversation. If you're buying it in ETF format, then of course you need to declare it. Okay, so that's the bottom line, right? Now, how to do it, talk to your CA. Okay, but long story short, this is where we are, that if you're looking for safe investment, gold is a better bet compared to bonds, right, in India right now for multiple reasons. I can make a separate video on this topic. So I hope that this first point is clear because I have assigned literally bonds as 0 everywhere, right? Why? Because this is a useless asset as of today in India. There is nothing left. It's just foolish. Try to invest from an investing lens in bonds when the inflation or de facto inflation for your segmental inflation is 10-12%. And you are getting like whatever, like 6%, 7% post-tax on bonds. It doesn't add up. Okay. So coming back now, if you have 1 crore, you are a low risk investor. What should you do? Okay. So number one, most of your money should go to stocks. It can go in stocks in two formats. One is mutual funds. If you tell a mutual fund, Falana Deemka scheme, that okay, go and put like 50 lakhs in it, then you might buy like 10 mutual funds. So they are eventually buying stocks only. So the underlying is stocks. Okay. So 50% you can do in mutual funds, 50% you can do in direct stocks, right? So this is like a simple way. Now you will say that, okay, then what's the point of doing like direct stocks? I don't like direct stocks because retail investors can lose money in direct stocks. See guys, retail investors can lose money everywhere, right? What type of retail investors lose money everywhere? People who are clueless, who don't want to learn anything. Okay. But a more natural question here is that, hey, why can't I keep 100% of my money in mutual funds? Because there is a problem with mutual funds. The problem is that you do not know when to sell mutual funds. The only rational argument that I keep hearing is that, hey, I invested like my mutual fund money in Falana Deemka scheme 5 years ago and it was 5 lakh rupees that I had total invested. Now it has become like 10 lakhs. So I'll book some profits. That's not the way profit booking is done. It's just clueless way of booking profits. You book profits and the market tells you to book profit, or if some investment theme is changed, or if you have invested in certain types of funds which are not aligning with your portfolio needs. So again, I mean, understanding it, right? How to invest even in mutual funds, you require to spend time. It's not as if that you can randomly go look at the Google ratings and, invest in like 5 funds. Okay. That doesn't work. Okay. So long story short, even to buy mutual funds, you need to put in work. Now, and still it doesn't solve your problem of selling it because no mutual fund manager is going to call you up and say that, hey, mere fund se bech do mal, right? So they are not going to do it. So therefore, you should take it as an opportunity to start learning a little bit about direct stock picking. Because what happens is that, see, number one, if you're picking large cap, stable companies, it's not as if that they will go to zero. Okay? Yes, you can suffer like 20-30% loss or whatever. And now, as long as you are diversified, for example, if you're not investing more than 5% of your capital on any single individual stock, blue chip, like HDFC or Kotak or whatever it is, it's not as if that you lose your money, right? I mean, if you're doing it in a basket manner, right? But if you follow simple 5% diversification, buy blue chips, direct stocks, then you get at least introduced to the entire concept of buying direct stocks, right? This is very important, right? So this is the first step that you should take. This is the low risk way of investing. It educates you also about the markets. It keeps you informed. Now, is that something that you should do? Well, choice is yours. One quote that I like to give here is that, see, you guys spend like 10 hours working in your jobs every day to make money. Now, if you can learn stock investing, maybe like by spending 30-40 minutes a day to preserve your wealth, then why not, right? You're spending so much time just earning money, and at the end of it, you just give it to someone randomly to manage it. That doesn't add up according to me. So yeah, I mean, that's logical, that's commonsensical. I'm not saying that don't go to doctors, but that does not mean that you should not learn anything about healthcare. Okay, so you should be smart enough consumer. So you can only become a smart consumer in the stock market if you are buying direct stocks. If you never take that step, then you will never become a smart consumer, right? So this is point one that I will tell you, and this is the very basic bifurcation. Then a normal question comes that, okay, you have written like real estate also. So should I buy real estate? See, the first real estate that you should buy, and this is something that I have witnessed after investing a lot of my own money in real estate, is that the first investment in real estate, don't call it an investment, call it a house. You should buy maybe a house to live, and you should try to do it at the lowest possible price point. That's what I would say. For example, I own a lot of expensive properties, but the house that I have bought to live, that did not cost me crazy amount of money. It's a nice spacious bungalow and all that stuff. That's separate. But long story short, that's not my most expensive real estate that I have went and purchased. So when you're buying your own house, try to buy it like from the secondary market. Don't buy it like primary, right? Primary means builder bana ke bech raha hai. That will be expensive. Buy like older units, better locations, more spacious. Buy that. That's a separate conversation. This is an optionality. This is not something that you need to do with a 1 crore portfolio, that you need to have like a real estate. But yes, having 1 crore rupee gives you the option of buying a real estate. Now, what do I mean by that? So for example, most of the real estate is purchased on 20% down payment, which means that if you have 20 lakh rupee, you can pretty much take a loan of 80 lakh and buy a 1 crore house, right? Now here, I would say that, hey, like with a 1 crore portfolio, the maximum amount of money you should be spending on your real estate is 33 lakh as down payment. Rest can be your financed option, right? So rest 66, you buy it in financing. Do not exceed more than 1.5 crore property, right? That's what I would leave you with. That's a thought process I will leave you with. Now, a lot of nuances go into buying like real estate, so I will not touch that topic. But long story short, if you're looking to buy house as an investment, do not do it. If you're looking to buy house as something that you want to live into, great. If you're getting a distressed deal, right? So here I have written, for example, here, real estate, only distressed deals, right? So this is for high risk investors. This is not for low risk investors. Why am I categorizing real estate as high risk? Because this will look contrarian. See, guys, the point is that real estate is illiquid. It's difficult to move, okay? When you have liquidity, and if you are sitting on large liquid money, then you can always explore opportunities. So for a low risk investor, it does not make sense, especially if you're young, like 20-30-year-old, right? You're going and buying like real estate, even to live, right? It might not make sense because you might not live in that city. You might buy something in Bangalore because you're 25 years old. You might think that, oh, I've fallen in love with that city. Then you go like, and you, every day you're stuck in traffic for like next 3 years, and then ho gaya moh prem bang. Okay, so then you go back, right? You say, leave it, like I'll go to some Himachal or whatever, beer billing and paragliding I'll do. So then you might want to do that, right? So long story short, this is okay, right? I'm not dissuading you from buying real estate, but if you're a low risk investor, then real estate investing does not make sense. That's what I would typically say, right, to 90% people. Now, okay, so then comes natural question, okay, bonds nahi khareedne, real estate is okay, maybe, right? Really depends. If I'm buying a house, then okay, fine. Depends on my age, depends on my lifestyle, vagera, vagera. So again, back to stocks. So what should I do? What type of stocks should I buy? Okay, so this is how I will give you categorization. You should have all four, right? So small mid caps, index funds, international stocks, and some domestic stocks, of course, right? So here, what I would say is, and these are the growth expectations and the actions that you need to take. See, I would say that if possible, try to keep a lot of your portfolio in small caps. This is the maximum that you should keep, 50. This can range between 50 to 30 to 50%, or maybe even 20 to 50% you should keep in small and mid caps, because now it depends on how low risk you want to be. If you want to be really low risk, then keep like 0% allocation on small and mid caps, which again does not make sense. But here, I would encourage that if you are okay, right, and if you can monitor, if you have a little bit of time, you want to learn direct stock picking, then have like 50% exposure to small mid caps. You don't need to start doing this small mid caps through you. You don't need to buy direct small and mid cap stocks. You can in fact dedicate your entire portfolio in mutual funds in small and mid caps. Let the fund manager do the headache there. Are they going to charge you more? Yes. Okay. What you can do directly is that you can buy index. You can buy international stocks directly. Now I'll put the links right in the description comment box in case you want to open up an account internationally, right? How to buy US stocks and all that. Very good companies which are top end. For example, if I talk about $1 trillion companies, there are 10 in the world, 8 are in US. There are 0 in India. So these are like high end players. Now again, if you talk about like 10 years from now, if there are $25 trillion companies, how many of them would be from the US? I would at least say 17, 18 will be from the US. Okay. So long story short, US is a great market to invest, especially in stocks. So have some exposure, start learning about it. At least keep like 20% of your portfolio international, rest 80% you can keep domestic, right? And this small mid cap, you can give it to mutual funds, let them handle it. Direct stocks, you can buy like in index format, index stocks near the direct, but at least like index plus blue chip you buy, and international stocks you buy, right? So that's what you should be doing. Now, in terms of returns expectation, see, whatever money you are putting in small and mid caps, that is likely to generate over a 5-year to 7-year period, 18% to 20% CAGR. Okay. So this very well beats your benchmark. If you're doing index only, then it is likely to generate 12%. Okay. This is again back tested, right? So this is likely to happen. It's not guaranteed it will happen. So this just barely meets inflation. International, in the last 10 years, the US market has done better compared to India market, right? And especially if you're buying tech, you can easily expect 14 to 15% returns in dollar terms, which is amazing, right? So this is something that you should add. Okay. So this is what I would do. And if you're considering individual blue chips, right, for example, Asian Paints ho gaya, ya DMart ho gaya, and all these companies, Bajaj Finance and all, then just simply do not buy it on overvaluation, right? And then you can expect to generate 14%. And if you learn something called as capital rotation, that how to rotate capital, it can generate more returns for you. So let me just quickly show you an example of capital rotation. So capital rotation means that, for example, banks, right? So you guys know that I was fairly bullish on a lot of banks, right? And I made very good money in the last 1.5 to 2 years. You can see that, hey, this is the channel, right? And let me just draw this off. So you'll see that, hey, this is the trading channel for HDFC Bank. Here it has consolidated. Now, if it falls in this channel, then the downside is higher for me, almost 10%. The upside is the resistance point. This is 8%. So this is a 1:1 trade. Okay. So at these type of junctures, I would typically book like 20% profit. Now let's say that I had like, 10 lakh rupees on HDFC Bank. Okay. Now I took out how much? 2 lakh rupee. Now this is the capital that I will rotate to other type of stocks. Now what other type of stocks I can look at? So, okay, so on a long 4, 5 years, 7-year period, what stocks will you look at? So let's look at something like Asian Paints, right? So I'll try to pick something which is completely pitawa, right? So Asian Paints, let's pick, okay? Now here is Asian Paints. Now if you take a look, bichara itna fuddu stock hai, right? I mean, it is on the other side of the spectrum now, right? The trading channel for Asian Paints was this, okay? It has actually broken that channel, right? So it is much, much down. Now, if you believe that, you know what, Asian Paints is a horrid company, it will never come back in the next 5, 7 years, then theek hai, chhod do, right? But in case, if it comes back up, right, then how much money do you stand to make, right? So this is 41% gain. Now, even if it takes like 2 years to come back to this level, then it's okay, right? So it's not as if that you're buying very expensive valuation. So this is the style of investing that you should do as a low risk investor, right? So this is where I'll end the conversation for low risk, right? And these are some of the types of stocks that you would need to know, right? So this I'll make like a video tomorrow for my member community students, right? So I will talk more about like, the different types of stocks, where exactly you can rotate, what is capital rotation, how to build portfolio. These are some basic concepts that you should know. So I'll aggregate a video for my YouTube member community students, right? And they can watch it, right? So that will be an exclusive video. So then comes the second type of investors, which is medium risk. Now what changes for medium risk? Okay. So see, again, the point is that you should keep majority of your money in stocks, mutual funds. Okay. Real estate, if you're looking to buy any real estate, then honestly, the type of real estate that you should buy, it should have two features. Number one is that it should be cash flow real estate. Now, cash flow means that it should at least have 4% yield. Which means that, for example, if you're buying a real estate worth 1 crore, at least 4 lakh should be the rent on that real estate. Okay. And this is for villas. If you're buying apartments, then it should be 6%, right? So 6 lakh should be the rent that you're getting. So this is first feature. And second is that it should be very flippable. For example, hota kya hai ki, for example, if you're buying like a 5 crore villa, now, and it might be giving you very good rent. But the problem is that when you go and look for buyers for a 5 crore villa, you might find it difficult to flip because you might not get too many buyers, right, at that ticket size. But if you're having a villa 1.5 to 2.5 crore villa, right, so these are slightly more liquid properties. So from an investing lens, these type of properties are good, right? And if you're getting some options, then definitely consider it. Till the time you don't get options, just stick to this and maybe add like 5% BTC. When I say crypto, it essentially means BTC. Right now, almost 7% of my portfolio is BTC. And I keep on fluctuating between 5 and 10%, right? And for high risk investors, you can keep it 10% of BTC. Now, why BTC? Because BTC is a asymmetric risk. It can give you very high returns and also it can go down in value. It can go to zero. I don't know. Okay. But in case you are bullish about BTC, then yeah, then having some exposure to BTC kind of makes sense. 5% exposure will not bankrupt you, right? So from that lens, you should definitely check out BTC. Which platform to use to buy BTC? Again, you can check CoinDCX. They are the most regulated platform in India. They are the category leaders, right? They are the most regulated by the Indian government, so to say. So from a safety point of view, they are number one. Right now, it's your call. Whichever platform you feel like buying cryptos from, you can do that. Okay. So this is what I would say. Now here, little bit strategy change, right? That for example, if you're looking to buy stocks, then I would say that at least have like 60 to 70% exposure in direct stocks and 30% mutual funds. Okay. Now why? Because, and what you need to do is that you need to learn capital rotation. And if you learn capital rotation and you're able to rotate capital twice a year, right? Hypothetically, that is called as churn rate. Now that actually adds a lot of returns for you, right? So for example, what I would say, I'll show you like an example from the US market, right? So for example, here is my portfolio on Google. Okay. So now here you can see that I'm sitting on decent profit. Now, if I decide to cut, let's say 20% position, where can I rotate? So this is Adobe chart. Okay. So Adobe, I can rotate some money. Why? Because it is undervalued, one could argue, in terms of its valuation. So agle 3-4 saal ke liye, if I just leave it and if Adobe comes up, that's a successful capital rotation. So this is the type of game that I will play right here. So this is medium risk, that I am not really changing the nature of the stocks that I'm buying. What I'm simply doing is that I'm changing the allocation. That 60-70% of my money is coming into direct stocks that I can rotate. Now, natural question comes that, hey, I don't have time. I'm like in a job and I cannot give like time. See, every day you don't need to trade. No one is asking you to become like an FNO trader and all that stuff. Okay. What I'm asking you to do is that, hey, every Saturday, Sunday, take out like 2 hours, study a little bit about the stocks that you have purchased and make like macro monthly moves. That's it. That's all you need to do. Okay. So that's what I would say. Okay. So then comes high risk dudes, right? So now what do high risk people do, right? So I would highly encourage you to be extremely opportunistic. That is the meaning of high risk, that you run after opportunities and there is a special segment that you cultivate. For example, this is called as frontier tech. For example, I am investing close to like 10-15% of my US portfolio in frontier tech. In the past, I had picked companies like Palantir, SMCI. I have exited both the companies. UiPath I had exited. All these companies had made very good money. Okay. I'm now going to pick something like ASTS maybe, right? So these are good companies, RKLB, IONQ. So these are quantum computing companies. One is a space company, just ASTS, space exploration. So all these are like, 1 to 100 bets, right? So either they are going to go to zero, right? From 100, $1 will convert into $100 or this $1 will go to $0. Okay. So now both are possibilities. I'll say, oh, right? Zero ho jayega. No one is asking you to put your entire net worth on this. Okay. Just put a small portion which you can afford. So this forms the basis of high risk. I'll say that, okay, I don't want to learn about like US market, all that stuff. See, I would encourage you. The more you know, the better it is. But if you don't want to, then pick unlisted. For example, NSE unlisted, I had picked at 1500, 1600. Right now it is going for 2400, not kidding. Okay. And this has happened in the matter of months. Okay. So I had made a video also, so you can check it out. So NSE solid stock. So from time to time, very good companies in unlisted space keeps coming up. I see a lot of, again, haters, right? You know, unlisted, like a manipulator, this, that. Why? It's not like that. Unlisted companies go through the IPO route to become legitimate public companies. So it's not as if that there is some problem in unlisted space or IPO space. It's just that you need to find like right type of companies to buy. Okay. So that's what I would say. Third thing, I will say that buy value large caps, not just simply large caps. Example would be that, for example, if you consider IT index, right? So here is IT index. For example, if you consider TCS, right? So this is TCS's chart. Right? So you'll see that for the last 4 years, right? So from August 2021, approximately 4 years have gone, right? The stock has not moved. It is available at its 4-year historic price, right? Now, technically, it looks okay, right? Now, fundamentally, are there issues with TCS? Yes, there is fundamental issues with all IT companies, right? They have not innovated enough. Now, if you really think that these companies are never going to come back, then it's a separate story, right? But my bet, right, or my reassessment of IT companies is that basically, right, as the data center theme picks up in India, you need like back-end operators who can kind of operationalize everything for all the data center companies. And that is where TCS and other companies might remodel things, right? There could be very critical data center companies in the sense that, for example, very secure information needs to be stored, which has like sovereign issues that, you know, it's India specific. So we don't want to give access to anyone. Then companies like TCS and all that come. So am I betting on like, you know, all wide variety of data center stocks? No, but this is a value play. Why value? Because for the last 4 years, nothing has moved on the stock. Okay. And it's not as if that revenue wise, the company has just shrunk, profits are going down, nothing is happening. No, it's not like a dying business. Okay. So it's like stagnating business, right? So we are just buying it at very good valuation and hopefully it will come up. Okay. So now then if you feel a little bit more adventurous, right? And if you're a high risk investor, then you should learn also options trading. Now this is not a push that you learn options trading and, you know, join some options trading course, nothing like that. But hota kya hai? Basically like, see, as a high risk investor, you need to hedge your risks, right? So I'm not asking you to sell options and buy options. I'm doing it from a risk mitigation perspective. So learning options trading really helps. Okay. Now then comes angel and VC funds also, right? So for example, I invest a lot of money. Now see guys, basically at 1 crore capital, you should not get into VC and angel and all that stuff. Here, I would say, I would at least suggest that you should be at $1 million plus of liquid wealth, right? If you're in $1 million plus, then you should start thinking about that, okay, 1 crore or 50 lakh capital, how I can put in angel or VC funds. That's an entirely different conversation, completely different skill set. But this is the meaning of high risk, mid risk and low risk from my side. And if I were to design like a 1 crore portfolio, this would be the easiest way that I would do it. I hope you enjoyed this conversation. If you did, do press the like button and I'll see you soon.